Do not trust here. So a popular 5-year retirement strategy using Bitcoin aims to generate tax-free income without selling your assets. This approach leverages Bitcoin's growth potential and certain financial tools to provide ongoing tax advantage cash flow for retirement. So here are the core strategy steps. You have the accumulate of Bitcoin, right? Begin by accumulating Bitcoin over a 5-year period. This can be done through lump sum purchases or regular dollar cost averaging. The goal is to build a substantial position as Bitcoin is seen as a high growth, borderless asset. Borrow against the Bitcoin, right? This is a strategic leverage. Instead of selling your Bitcoin, which would trigger capital gains taxes, you borrow against your holdings using crypto-backed loans. This allows you to access cash without selling your principal. So the borrowed funds are considered debt, not income, so they are not taxed. The next one we have is the tax-free income generation. So by borrowing a conservative percentage, like 10 to 15% loan to value of your Bitcoin's value each year, you can generate tax-free cash flow. For example, if you hold one Bitcoin worth 100 grand, you could borrow 13,000 annually at a 13% LTV, using part of the loan for an interest reserve and the rest as spendable income. You can maintain and grow the principal. So because you're not selling your Bitcoin, your principal continues to benefit from potential appreciation. So this strategy also allows you to pass on your Bitcoin to heirs, potentially growing generational wealth. You know, we like that. There's tax advantage retirement accounts like the Roth IRA for true tax-free withdrawals. Consider holding Bitcoin in a Roth IRA. Contributions are made, with after-tax dollars, but all growth and qualified withdrawals after age 59 and a half and 5 years are tax-free. So this is ideal for long-term holders expecting significant appreciation. There's traditional IRA/SEP. IRA or simple IRA. So these accounts offer tax deferred growth, but withdrawals are taxed as ordinary income in retirement considerations and risks, right? There's extreme volatility to be, that you must take into account. So Bitcoin is known for dramatic price swings, sometimes losing or gaining double-digit percentages in a single day or week. So this volatility can be particularly risky for retirement planning, especially if you need to access funds during a downturn. Now, in regards to regulatory uncertainty, cryptocurrency regulations are evolving and can change rapidly, affecting how Bitcoin is taxed, traded, or even held in retirement accounts. Regulatory changes could impact liquidity, custodianship, and even force you to liquidate holdings unexpectedly. There are higher fees and costs, so self-directed crypto IRAs and other retirement accounts that hold Bitcoin typically charge higher setup, trading, and custody fees than traditional accounts. These fees can erode returns over time, offsetting some of the tax advantages. There's security and user error. So Bitcoin is a bearer asset. So if you lose your private keys or make a transaction mistake, your funds can be lost permanently. Custodial risk also exists if you rely on third parties to hold your assets. Now, let's talk about liquidity and transaction delays. Selling or moving Bitcoin in retirement accounts, especially self-directed IRAs, can be slow or cumbersome, sometimes taking days to process transactions. So this can make it difficult to react quickly to market changes or access funds in emergencies. There is no tax loss harvesting in retirement accounts. Unlike taxable accounts, you cannot use tax loss harvesting strategies in retirement accounts to offset gains with losses. This removes a potential tax management tool, especially in volatile markets. Portfolio allocation and diversification. Most financial advisors recommend limiting Bitcoin and other cryptocurrencies to a small percentage, often 5% or less, if your total retirement portfolio, due to their risk profile. So over concentration can jeopardize your overall retirement security. Withdrawal and contribution rules are as goes. Standard IRA and 401k rules apply. Early withdrawals may incur penalties and taxes, and you typically cannot withdraw actual Bitcoin. You must sell it for cash first. Contribution limits also apply across all your IRA accounts. There's potential for loss of principal. If Bitcoin's price collapses or fails to recover, you could lose a significant portion or all of your retirement savings allocated to it. So this could force you to delay retirement or reduce your standard of living. Now, here is why Bitcoin is typically considered better an asset for early retirement compared to traditional investments. So there's high, growth potential. Bitcoin has demonstrated exponential growth since its inception, with average annual returns far exceeding those of traditional portfolios. For example, since 2009, Bitcoin's price has increased by an average of over 100% per year, while a standard 60/40 stock bond portfolio typically returns about 7% annually. This outsized growth potential can accelerate wealth accumulation, making early retirement more attainable for those willing to accept higher risk. Okay, there's portfolio diversification. So Bitcoin's price movements often show low correlation with traditional assets like stocks and bonds. Adding Bitcoin to a retirement portfolio can enhance diversification, potentially improving risk-adjusted returns and reducing overall portfolio volatility. This unique correlation profile is valuable for investors seeking both growth and stability in their retirement planning. There's the inflation hedge. So Bitcoin's capped supply of 21 million coins makes it theoretically resistant to inflation, unlike fiat currencies that can be printed at will. This scarcity appeals to investors looking to preserve purchasing power over the long term, especially as inflation erodes the value of the traditional assets. There are tax advantages in retirement accounts. So holding Bitcoin in tax advantage accounts like Roth IRAs allows for tax-free growth and withdrawals, applying the benefits of its high return potential. Gains that would otherwise be subject to capital gains taxes can compound tax-free within these accounts. There's accessibility and innovation. So Bitcoin provides exposure to the rapidly evolving blockchain and digital asset ecosystem, which some view as a transformative technological innovation. So early adopters may benefit from participating in these growth sector before it becomes mainstream. Now, here are the key steps to implement a Bitcoin-based retirement plan. You have to research and education. So understand Bitcoin's historical performance, volatility, and role as a potential inflation hedge. Familiarize yourself with the risks, tax implications, and custodial requirements unique to cryptocurrency, retirement investing. You're going to want to choose the right retirement account. So opt for a self-directed IRA, right, which also is known as a SDIRA, or a crypto-enabled 401k plan, as traditional retirement accounts typically do not support direct crypto investments. For IRAs, select between a Roth tax-free withdrawals in retirement or traditional tax-deferred growth structure, depending on your tax strategy. Some 401k providers like Fidelity, For Us All, etc., now offer crypto investment options, through self-directed brokerage windows. Select a trusted custodian or platform. So choose a reputable custodian or exchange specializing in crypto IRAs or crypto-enabled 401ks. So look for strong security features such as cold storage and two-factor authentication. Common platforms include iTrust Capital, Bitcoin IRA, Bit IRA, and Coin IRA. You're going to want to fund your account. So fund your account via direct contributions, subject to annual IRA limits, or by rolling over funds from an existing IRA or 401k. Ensure you follow IRS rollover guidelines to avoid unnecessary taxes or penalties. Purchase and secure the Bitcoin, right? Use your account to buy Bitcoin and, if desired, other cryptocurrencies. So if your custodian typically provides a secure wallet, often with cold storage for added protection, regularly monitor your holdings and security settings. Diversify and rebalance, right? So avoid over concentration in Bitcoin. Consider diversifying across multiple cryptocurrencies and balancing with traditional assets in managed risk. So periodically review and rebalance your portfolio according to your risk tolerance and retirement goals. Monitor regulatory and tax changes. So stay updated on IRS rules and retirement account regulations regarding crypto assets, as these can evolve and impact your strategy. Plan withdrawals strategically. So for Roth IRAs, qualified withdrawals are tax-free after age 59 and a half and 5 years of account ownership. For traditional IRAs, withdrawals are taxed as ordinary income. So play or plan your withdrawal timing as to maximize tax efficiency and minimize penalties. I appreciate your viewership. Stay safe. See you on the next video.